Hello. We're pleased to catch up with Bill Fink, Executive Vice President and Head of Middle Market Banking for TD Bank. Bill, welcome.
Jack, it's a pleasure to be here. Thank you for the opportunity to chat.
Yeah, Bill. So it was only last month, really, that I saw you had written an article that caught my eye. 5 ways middle market CFOs can make sound financial decisions. And just given how the current environment is ever changing, we thought we should revisit the 5 ways with you and see if you can offer any insights or new comments. How's that sound with you?
That works for me. Thank you.
Great. So let's just begin with the very first one, refinance. Is it too late? What would you say?
I would say, Jack, it depends. And maybe that's the classic answer, but it depends in this regard. So what's the time frame over which you would refinance, and what's the differential in interest rate from where you're starting to where rates are today? The old rule of thumb in, I'll say, residential mortgage banking, that isn't a perfect, I'll say, analogy for what we're doing, is that rates had to be 200 basis points or 2% difference in order to make refinancing make sense. My view is it's not that simple. And so when you look at where rates are today, and since March, the Fed's raised the Fed funds rate 150 basis points. And there's an expectation that they may raise through the balance of this year and potentially into the early portion of next year. They could raise another 100 to 150 basis points. If you take that differential and use it as a starting point, you look at, and I'll use a simple example of $1 million loan, which could be for equipment, it could be for investment, and other types of capital equipment within a business. So today, a comparable market rate, whether you're looking at LIBOR or SOFR, would be about 4%. And for those who follow those two benchmarks, you're looking at a margin over LIBOR or SOFR on a 30-day basis, something in the area of 240 to 250 basis points. And so if you start there, you look at $1 million loan at 4% for 60 months, you would have an $18,400 payment per month. And the interest cost over 12 months, the first 12, or the life of the loan, would be $104,000. If rates go up from where they are today, 150 basis points, your 4% rate goes to 5.5, and the total interest cost over the life of the loan moves from $104,900 to $146,000. So you can see the difference is over $40,000. In that case, it may be enough to refinance, particularly if it's a 5-year loan. When you get out to 7 and 10 years, which is kind of the upper limit for capital equipment, and if you have owner-occupied real estate to operate the business out of, it begins to make better sense as you go out on the curve. So I wish there was one simple answer, but you got to put pen to paper and begin to do the math and determine whether it makes sense or not. But I would expect as rates continue to go, and if the interest rate increase from where we are today by the Fed potentially moves out beyond 200 basis points, if that's the new time horizon and the new differential, it may make very good sense to consider refinancing.
Well, the second item you had was be mindful of the expected yields. Now, you made that number 2. I was curious, what is he trying to say about mid-market businesses? I mean, they don't have their eye on the ball always? What are you suggesting here?
Well, I would say we talked about the loan side, so be mindful of expected yields on the loan side. And people really, CFOs who are on top of their game, and most are, really look at the debt side, because debt is proportionately often a significant part of their balance sheet and managing that expense. So that's the easy one. And because it's so focal, I often say to people, don't lose sight of what you're doing with your idle cash. And so if you're not going to invest your working capital in your excess liquidity, which is a safety cushion, you're not going to invest that long term. So being mindful of what's happening with yields, and as we saw from March, the Fed's moved 150 basis points. That has not fully translated into 150 basis points in deposit rates. It's been something less, but as we continue to have an upward trend in Fed funds rate, that will translate. So this is the perfect opportunity, not only to look at the rate, but look at where are you putting your excess liquidity and your excess working capital. Look at the mix of products on a short-term basis. If you're in bank funds, you can look at money market mutual funds, you can look at repos, you can look at some combination of all of them to get the maximum return on that idle cash to bring return to the company. Because there's nothing worse, the least productive asset is idle cash. So you need to be sure as the opportunity presents, you're maximizing that return.
Your next item I thought was interesting, just because finance leaders, the mantra is to be looking forward, and they're forecasting and reforecasting, and they're doing scenario planning, trying to understand what the future might bring. But you're telling them, no, you got to look backwards too. Learn from the past. What do I have that right? Or and interestingly, they're not always very good at this. Why? What are you sharing here, however?
Well, I look at it, Jack, from this standpoint is look in the past, learn from the past, and use that as a tool for the future as you continue to look at your business, you continue to look at opportunities. And the reason why I say that is I have had clients from 2001, 2002, during that recession, during the Great Recession. And what I have found is people who are mindful of opportunity, and that's what happened in the last two recessions, is that there were opportunities to do bolt-on acquisitions, to do divestitures, to strategic reposition the business, to take advantage of where others in a competitive frame of reference may not be as aggressive. And you look to reposition the business potentially into new markets, deepen existing markets, or divest again businesses that don't have a long-term strategic fit. And many people hunker down as times become more uncertain. And we're clearly in uncertain times with any number of factors driving that uncertainty, from supply chain issues to increasing interest rates to the war in Ukraine, to port issues in Asia that are still shut down. This is an opportunity. If you have an outlook on your business, that outlook is positive, that there's reoccurring revenue, reasonable, I'll say, stability to EBITDA and cash flow. This could be the opportunity to take full advantage of positioning the business to make an acquisition or to do a divestiture that positions the business for the future.
And if you have a list of capital equipment that you have been wanting to buy for some time, it might be time to invest in capital equipment. Agreed?
I agree. And from a number of viewpoints. So when you look at the present environment, you look at unemployment is near an historic low, recently 3.6%. The 50-year low is 3.5. You look at the JOLTS index, there's a half a person theoretically for every job that's available today in the marketplace. So there's a huge imbalance. So when I look at capital equipment, and as I talk to presidents of companies, CFOs of companies leading TD's U.S. middle market banking effort, you hear again and again, we've got to be more efficient. We've got to drive down our labor costs where it can, and not every business can take advantage of this. But are there ways to become more productive, efficient than what you are today? And part of that answer may come in the way of advanced robotics, I'll say business operations approaches that are different, that bring efficiencies that you haven't focused on them in the past because labor had been there. Labor costs had been reasonably contained to what we've seen in the last 6, 12, 18 months.
And your last item I thought was particularly interesting. It's something that I think finance executives are routinely tasked with. I'm not sure they're always getting it right, but it's determine what's impactful, what's really making an impact here. And I guess you're saying stay focused on that, or is it something different?
Well, that is part of it. And so it's easy to say stay focused. That's a very kind of topical statement. And I would say, as I talk with CEOs, CFOs, what staying focused means is really trying to bring clarity where there's tremendous ambiguity right now. There's a myriad of, I'll say, intersecting challenges that are not singular. And we like to boil things down to say, well, there's one or two things we need to do X, to drive our business, to change our business. And as I talk to people, they laugh about it and say, Bill, don't we all wish it was that simple? And I really step back and say that there's tremendous uncertainty right now, and it's been layered in. It isn't at all that it occurred. I think back, Jack, I can remember sitting in this office on March 19, 2020, which was the last day we were in the office before we went all remote and across the country. Businesses shut down across various states. There were mandates to work from home. And that was kind of phase one. The COVID pandemic became real. We really understood what it was, what this health threat was. That was step one. We migrated through, vaccines came, but then kind of round two began to materialize. And people stayed home and they bought certainly more tangible goods because services, from restaurants to nail salons to getting simple haircuts, wasn't available. So the capital goods demand skyrocketed while we couldn't keep pace from a production standpoint, a shipping standpoint, and then even COVID impacted the ability to ship, to produce. And then as a result, we've had a mass retirement that we've never experienced in such a compressed period of time. We've had labor disruption. Now we continue to have shipping disruption. So all of this has been like a big stew, if I could liken it to that. And to say they've got to stay focused, well, it's staying focused and trying to decipher many different conflicting demands on the business. And I look at it and say, you step back and really, as you try to do that, I look at it, your strategic planning and your operational planning and monitoring. If there's anything that's come out of the pandemic and the aftermath, the need for consistent strategic planning, of which contingency planning is one small part, but then operational reviews to determine how the business is functioning, what's impacting the business. Businesses that have that as an ingrained skill set have been able to find their way through, in my mind, and what we see at the bank, more consistently than businesses who didn't have those ingrained disciplines. And so I would say the takeaway in this segment is, do you have, from a strategic planning standpoint, operational control standpoint, do you have that embedded in your business? Because the ones that do have been able to weather this, and I would expect continue to weather the unknown challenges that we'll face into the future.
Yeah, great question for CFOs to be asking themselves. Bill Fink, head of middle market banking for TD Bank. Thank you for joining us.
Jack, it's my pleasure. Thank you for the opportunity. Please stay well.
Likewise. Thank you.
You're welcome.